current times at the moment. My name is Taryn Wade, and I head up research for leverage commentary and data in London. And we cover the broadly syndicated market as well as the direct lending market on the debt side. And we cover the global market, so US and Europe. And I would like my panelists to actually introduce themselves to you today. Would you like to start, Pia?
Sure, thank you, Taron, and nice to be here, everyone. So my name is Pia Cole. I'm managing partner for CapMan Buyout. So we are a Nordic lower mid-market buyout fund, investing now from our 11th fund across sectors, but basically looking for companies where we see growth, niche market leaders, regardless of the sectors, and then also spending a lot of time understanding the culture in the companies. But really focus Finland, Sweden, some of Norway, Denmark.
Great, thank you. Olivier, do you want to go next?
Yeah, please. So Olivier Laine, I'm working for Facto France, which is an affiliate of Crédit Mutuel Group. I'm doing especially account receivable financing, factoring, and sometimes securitization. Doing that since a long time. We have also a focus on transaction with private equity, LBOs, in order to provide this sort of financing, higher financing to them, and we do that since more than 15 years now.
Great, thank you. Munir?
Yes, hello. So my name is Munir Latef. I'm a lawyer. I'm a partner at Winston & Strawn Paris office. I head the leverage finance team, so I do a lot of private equity and leverage finance, both for lenders and borrowers. And in terms of lenders, I do a lot for direct lending actors of the market.
Great, thank you so much. So I think one of the things that we've noticed that has been particularly notable since the start of the pandemic has been that the private equity and the debt markets seem to have recovered quite quickly, at least on first glance. So I wanted to ask all of you, how true do you find that statement to be? Are there exceptions? You know, how are you finding the market at the moment? Pia, do you want to start?
Sure, thanks. So I totally agree with you. If you take a helicopter view of the market, then deal activity is very high, and debt financing or debt availability is also very good. And I would say back to normal. So the last spring you had a freeze for a couple of months, but now really market being back. But I think when you look on a micro level or go a slightly deeper, then it's more nuanced than that. So both on debt availability and on deal activity, we see quite a bit of a binary split, with a strong kind of sectorial split between lenders strongly preferring some sectors, the kind of obviously COVID-proof sectors like software, healthcare, some technology companies. And then there's other sectors like hospitality, retail, some more kind of capex heavy industries where I would say there's a lot less interest at the moment, almost on a sectoral kind of no-go level. And in a way, I think this is a challenge because we look across sectors and really think there's good companies in every sector, and there's bad apples in every sector, and you need to go to a deeper level to really see what is viable in a COVID environment. We see the same kind of activity on or focus on the deal side, where some assets really attract a lot of interest at the moment. Same sectors that are very COVID-proof and attractive. Very kind of hot auction processes, etc., with valuations really going through the roof, also on very small companies. And then we have less obvious cases or kind of less obviously hot assets where we see a lot of attractive cases good assets, maybe not so obvious sectors, but really doing well in this market environment. There you have a lot less interest, but also a lot less availability of debt in these cases. Good thing, of course, is from our point of view, making investment, that there's less interest and there's a lot of one-on-one discussions with families or founder-owned companies that are now looking to share risk or take in a partner to be able to capture growth opportunities in this market.
Okay, that's very interesting. Do any of the other panelists have views on that as well?
Well, I think yes, as it has been said, I mean, the deal values and the fundraising is still very strong, and we see that the market has recovered. The drop, I would say, of the level of the deals in the second quarter of 2020 is basically creating new opportunities today, and we see that the market is very active. It's been very active on the last quarter, and is now very, very active. And I think there are a lot of new investment opportunities that we are seeing today because of that drop in 2020. And what I would say, I mean, the sector shift is basically a reality. I think the main word here is deeper specialization, and I would say deeper being more innovative. That's what we're saying. Businesses that are more innovative are the ones that are doing the best at this moment.
And when you say innovative, do you mean reacting to the pandemic or just more generally disruptive sectors?
No, just more generally. I mean, if you look at sectors like, I mean, we're discussing about the retail sector. I mean, I mean, we know there's a huge crisis in the retail sector. However, you have part of the retail sector that still is still working. I mean, and you see that the companies and the industry that's working in this sector are the ones that are the more innovative, the ones that have built open skies, for instance, retail park. Those are still open today everywhere. So, and they're still doing well. So I think it's more a question of differentiation and being more up to date and more adapted to the crisis and to the sanitary regulation that's helping companies more than others.
Okay, interesting. So probably those companies that were already being disrupted, they were sort of ready for this a bit more. Yeah. Olivier?
Yeah, well, I share the view of my colleagues. I mean, you've got some sectors where it will be very difficult to have interesting transactions. I will say all sectors like automotive, aircraft industry, that has been very damaged. So for the moment, I think it's too early to see transaction in that area. At the opposite, you've got a very interesting deal in the pharma business, in IT, you know, all the sectors that provide the ability to work distantly. We have seen a couple of interesting transactions in that area. After that, you know, every crisis at the end will create lots of opportunities. So I think the market start to be very active. We see transactions in the market, and it will continue to increase in the coming months. I'm absolutely convinced that the number of opportunities we will see on the market in both sides of the Atlantic are going to increase significantly.
Yeah, and if you look at the US as well, I mean, are you seeing any differences in those two markets, Europe versus US?
Well, I don't have an helicopter view, as Pia said, but I mean, we observe that the US market recovers faster than the European one, and they are a little bit in advance in the solution of the pandemic. Certainly, and as always, you know, they react faster than Europe. So I will say they recover faster, and there is a significant amount of transaction in the US, less in Europe, in my opinion. But I don't have a full view of the market, so.
Yeah, I would say that we find that generally with our data as well, that the US does sort of, like Europe sort of follows the US in terms of the more broadly syndicated market at least as well. Okay, so we've talked about sector focus. What about the principles of financing? So how deals are structured in terms of the debt versus equity mix, which is the general structure. Munir, do you want to take that one?
Yeah, sure. Well, as what we've noticed is basically, I mean, we've talked about the level of dry powder on the market. So we know that there is capital on the market, and this basically is to the benefit a lot to private lender and unitranche lender, because they're being still very active on the market and very aggressive on the market. What we are noticing is that basically deals are done on a certain level of leverage that is more reasonable than what it used to be before the crisis. And I think it's funny to say that this tendency comes mainly from the sponsors. Sponsors are being more conservative today than what they were prior to the crisis. And well, I'm experiencing deals at the moment where basically lenders are pushing the level at a higher level, and sponsors are being more conservative and saying, no, we will stay at a certain level of leverage ratio, and we'll see. Maybe in the near future, when we get out of this crisis, we will do a recap. So that's basically the tendency that we're seeing today on the market, and this is quite new, and but it's I think it's a reasonable approach.
I could echo that, all of those trends that you say, that it's especially when we look at these, like you call, more difficult sectors, or where it's not as obvious to get the financing. I mean, also considering all equity transactions and then financing them later on, or then, as you say, more reasonable debt levels. I think they're maybe Nordics in the general, in the lower mid-market, but especially we have kept fairly reasonable levels all the time, so 2 to 3 times leverage ratios. That helped us through the pandemic for sure, or through 2020, really making it easier to get the portfolio through it. And I think that's something that everyone is now paying more attention to. What's the liquidity buffer or the cash buffer, also in a lower growth scenario than maybe the really full potential value creation scenario. And they're also seeing those same situation, that lenders might be actually offering more leverage than what we think is reasonable and comfortable in the investments.
Okay. Olivier, what about you?
Well, I agree with Munir. On the last transaction we saw on the market, the level of equity check was higher than in 2018 or 2019. I mean, sponsors, maybe it's sponsors that are pushing for that to increase the equity check. On the other side, I think lender has been a little bit more conservative and didn't want to put a huge amount of debt on transaction, and in particular banks. I think perhaps alternative debts or private debts, they are more in a situation where they want to push to invest the dry power that you can see on the market. But banks has been a little bit focused on I mean, in France, PGE and COVID, the loans in order to protect and to help companies. So certainly they didn't want to put too much money in a new transaction and large amount of debt. So that was a situation due to the pandemic. It is, in my opinion, a little bit difficult to know what's going to happen this year and next year. Maybe things will be back to what we can call normals with a very high amount of debt, less equity, and a volunteer of the sponsors to be quite aggressive in the structure, or maybe the equity check will continue to be higher than previously. I think it will depend a lot of the quality of the recovery post-COVID crisis, because we are not yet in a situation of recovery. So it's a little bit difficult to know exactly what's going to happen. The market can react very quickly, and I think it's what we learn.
Yeah, I mean, I think we've seen a similar trend in the larger deals of equity checks being still quite high. I think that's given investors some comfort. But the other area where there's been comfort from investors is on pricing. It has started to come down in the broadly syndicated market, so it's not compensating them as much for the risk. Olivia, going back to you, I mean, how are you seeing pricing unfold on deals that you're looking at?
Well, it depends what you mean by pricing. If it's the pricing of the transaction, it's quite complex. I think on very interesting sectors, price are very high. There's not so many opportunities during the crisis, so it was a good situation to have a good price. If you are asking me what is the price of the debt actually in transaction, I will say there's so many liquidity on the market that the price are very low. In my opinion, and as a financier, I hope they will not go below that. We start to see an increase of the long-term rates in the US that can have an impact on the price. So I think the price of the financing is really low due to the liquidity, due to the fact that you don't have so many deals actually that are closed. If the market recovers very quickly, maybe the liquidity will be a little bit more difficult to get access, so the price will increase. But I think this situation will remain constant for a couple of months, and prices are going to stay the same.
Yeah, I mean, there just is so much liquidity out there that it is very low. Munir, Pia, do either of you have a view on pricing for debt?
Yeah, I would agree that we haven't seen any kind of major changes there, and they have stayed on a low level. It's more a kind of all or nothing approach in a way to deals, that some that are, especially when we talk about the banks and senior lenders, that if it's in the sectors that they don't like, then it's a no-go. It's not a question about pricing, and then it's the sectors that are interesting or hot in their opinion, so then it's available, and not really any change on pricing. There are rather quite a high competition, like you were also saying.
Yeah.
You know, there's so many liquidity, then on a good transaction, the price will be, there's a real discussion on the price, and they will go down. If it's a sectors where nobody wants to go, in fact, no money will be invested, so it's not a matter of price.
Exactly.
Yeah. I think it goes back to the original point for the first question that we talked about, that it is a bifurcated market. What about documentation on transactions? Munir, what are you seeing in terms of trends at the moment?
Well, what we're seeing, I would say, is basically an increase of the level of due diligence and the level of reporting that is required by the lenders in the documentation. I think the market has shifted also a little bit on the covenants. We were in a situation of a covenant light situation or a no covenant situation, and we're back. I mean, if I have to speak about the sector I'm working in, which is the mid market basically, or the higher mid market, I think that we're back to some kind of covenants in the documentation that had disappeared prior to the documentation, especially when you look at build up lines. I think that the lenders are being more careful on you know, having look forward tests and look back tests that had disappeared at some point, that are come back. They're being more difficult on synergies, and so I think, globally speaking, I would say a higher level of due diligence and a higher level of reporting. Lenders are also very careful on permitted indebtedness. I think that, I mean, especially in France, if we have to talk about geographically speaking, as you know, the state guarantee loans that have been massively deployed by banks on the market have had a kind, in a certain way, a disruptive effect on the financing market. And so what we're seeing is that lenders are being very careful on limiting as much as possible the permitted indebtedness baskets that you would normally have in finance documentations.
Okay. That's interesting. Anything else from the other panelists that you're seeing on documentation specifically?
Yeah, on recent documentation that I have access to, basically it's right. We can see, I will not say a more conservative approach, but a little bit of more covenants. I mean, covenants free, we don't see them anymore. I mean, both the sponsors and the lenders are concerned about that, and they are more careful. I will add something on the PGE in France. It's right, it's a super senior facility, so basically it has created some disturbance on the market, because on transaction where you had permitted basket, it was difficult to know if that working capital facility, in fact, PGE was part of the financing of the operational company, or had to be put on the top co level. I mean, on large transaction, it didn't create any issue, and I think lenders were quite flexible. On the mid-cap, small market, it was certainly much more difficult, because situations are a little bit more tense, and an increase of debt was not really appreciated by the lenders, especially when they come from the Anglo-Saxon world.
Yeah, well, I mean, I think we're going to have all these things tested. At the moment, there's so much liquidity that we actually are seeing fewer and fewer restructurings happening. There was a slew of them sort of towards the end of last year, but I think a lot of these situations have been kicked down the road, so we won't really know the results until we start to see more of them. We actually have a question from the audience. So before moving on to the next question I was going to ask you, because it is related to this, I just wanted to throw it out to the panel. What are the optimal structures to refinance deals right now, particularly as interest rates are so low? You know, is it optimal to increase debt? This relates back to what we were talking about before. Does anyone have a view?
It's super situation dependent, right? It's of course, financing is there. So if you have a very solid case where it's with very low debt level at the moment, you could refinance and increase debt levels. But on the other hand, you have that consideration that market is very uncertain at the moment. Outlook is very uncertain, basically in every sector. So that same conservative approach on not increasing leverage ratios too much at the same time. So I don't think there's, at least I don't have a general answer. It's really situation dependent.
Yeah, I fully agree with you. In fact, you need to have a certain level of certainty on the profitability of the company. I mean, the EBITDA that will be generated in the coming years. If you're confident that, and if you're in the sectors where you've got visibility and you know that you will not have another accident, because we never know, at the moment there's uncertainty, even if the COVID crisis seems to be we see the end of the tunnel. To refinance seniors facility I mean, you need to have that visibility. After that, if you have to refinance the RCF or revolver facility or, I mean, the financing of the working cap, well, there's opportunity on the market to find this kind of debt at the moment. So maybe it could be interesting to do it now.
Yeah, and I guess there's a play also between exit timing and refinancing if you're in the later stage of an investment. So if you already have quite low levels, but for whatever reason in this market situation, you don't want to go for an exit, even if there is an active transaction market out there. Refinancing and postponing maybe, but again, it goes down to the asset level. And that's actually there, back to the previous discussion, maybe counterintuitive from a sponsor, but I think it's good that lenders do a bit more due diligence, more detailed, because we go down then into that value chain position, really position in the kind of within a broader sector. And if you have a good innovative company there, then that financing is available also in the less hot sectors. So I think they tie together. So if you're certain about your position outlook, then the opportunity is there.
Great. Munir, did you have anything to add?
I think unfortunately it was probably the right moment to refinance and restructure. I mean, the crisis that we went through was probably the good moment for sponsors and companies and borrowers and lenders to sit around the table and try to discuss the reorganization of the financing, refinancing of their debt. I think that this opportunity has not been taken because, and that's one of the disruptive effect of the state subsidies or loans, because companies didn't need to do it, and obviously there was a risk for them to doing it because they were coming from lighter documentation, lighter financing condition, and they were going to go to maybe more complex and more strict conditions. But I think globally speaking, this opportunity should have been taken. It's a more long-term view than a short-term view, and unfortunately, it has not been the case.
I agree with you, but I would also turn it around in the sense that companies did not have to, but also lenders were very reluctant to go into that discussion. So even in situations where maybe as a sponsor you say this is really what makes sense for all parties, the sentiment was very much to just push everything ahead and hope that we get out of this soon.
Okay. Just to change the subject a bit, ESG investing is a really hot topic area at the moment. I know we get questions from clients all the time on how much data we have on ESG companies versus non-ESG or deals that are linked to ESG factors. Are you seeing this in private equity and direct lending? What activity? What are you interested in? Pia, do you want to talk about that?
Yeah, sure. No, I think it's an extremely interesting topic, and we see more and more of it, and I think that's very welcome. I think the way we approach it or think about it is, I mean, we've been, well, basically for 10 years now, been a signatory of the UN Principle for Responsible Investment. So it's been part of ESG, sustainability has been part of the investment strategy for a long time. It's been risk, but now it's also a value creation opportunity. And for us, it's a lot about, it's not investing in green companies or kind of impact investing in that sense that it would already be green and clean companies, but it's across sectors. Can you help companies transform towards more sustainable? But I think it's interesting now when we start to see these credit facilities or financing options where you have ESG linked, for example, margins, because I think one of the challenges has been that sustainability is so broad and it's very easy to talk about it on a greenwashing level, but how do you really do metrics that really matter or actions that really matter? And what I like in this financing is that when you can tie it to something that's really kind of company specific and makes sense for that company. So if you can have margin tied to CO2 footprint is of course an usual one or easy one, but also say we've seen grocery chains or retail have it tied to reduction of food waste or reduction of waste in general, or healthcare companies where it's tied to employees or customer satisfaction or other metrics that are very company specific. So then I think actually you try to get the balance where there's actually financial incentives as well to do the stuff that we see from an investment perspective makes sense, but then you also get the lending part into it. So I think it's interesting, but it's been more in the bigger companies, upper mid-market, large cap, where we've seen it. And now we start to have more discussions in the lower mid-market and kind of our size companies as well. So hope that we will see even more of it.
And do you have a specific principle that your firm sticks to? Do you have an ESG mandate, or is it case by case?
So we have an ESG policy and a kind of an ESG what do you call it, framework that we follow. We don't have specific investment strategies that would be ESG related only, but it's embedded in all the investments that we do. So regardless of the sector or the company we're looking at, ESG is kind of part of both the due diligence phase and then the value creation phase. So both looking from a risk perspective, and then we look at it from a value creation perspective, and this value creation or additional value that can be created, that has taken more and more focus. And quite often there's a good alignment. I think if you can reduce waste, if you can reduce energy consumption, if you can just be more resource efficient in general, usually that's a direct link also to better profitability. So it's more those type of mandates, or kind of not mandates, but actions that we look at.
Okay.
Where it's really tying together the financial and the sustainability actions.
And have you found that your policy has changed recently, or is this something that has always been in place?
It's been in place for more than, what is it now, about 10 years or so, that it's been in place in some way, that we always take the ESG aspect. What has changed over the last, let's say, 4 years or more, 4 or 5 years, is that balance from only risk mitigation has shifted to a balance of risk mitigation and value creation. So, and now it starts to be a buzzword. Now everyone talks about it, but it's been there in the background all the time in what we've been doing.
Yes, I'm sure that's the case with a lot of investors. Anything else to add, Olivier or Munya?
Yeah, well, I will say on that subject, banks are changing their view on that. You know, if you want to finance an activity in mining, or if you want to finance energy production based on coal, it will be very difficult to find a bank that go in that sectors and will give you any money or anything. We call it in the banks the RSE policy, which is basically we are very careful on the sectors we are going to finance. It's not only, environmental impact, it can be also weaponry or these sort of things, but it's exactly the same approach. And this is quite new. You know, it was always a subject, but it started to be a policy. So this is the change.
Right.
I think the change is happening now across the line. So banks are reacting, like you say. I think sponsors are more and more aware, but also entrepreneurs, CEOs, kind of the next generation of CEOs and entrepreneurs who build their companies now, they are also very much aware, and it's social impact as much as it is environmental. So it's really everything that has to do with employee, customer, supply chain. That's also coming a push from their side, that they want that to be high on the agenda.
Okay.
Yeah, we're seeing more and more. We're seeing more and more. I mean, we're getting more and more mandates on negotiation and setting up, sustainable bond financings and at many levels. I mean, generally for for big corporate companies, and but we're seeing more and more of that, definitely.
Yeah, it's definitely, it's everywhere at the moment. So I have another question from the audience. It's about factoring. Is France a large market in factoring?
Oh yeah, France is a large market in account receivable financing and factoring also. I mean, the French player are the ones that have developed a capability to provide this kind of financing all over Europe and even on the other side of the Atlantic or Australia. So yes, the market is strong and very well developed. It's also a market that is moving to, I mean, financing of LBOs and private equity or acquisition or all of that, mainly due to the fact that it's quite interesting product in a sense that you can deleverage a transaction by replacing a classic RCF with a factoring or an account receivable financing, especially if you are able to structure it off balance, and like that you're able to decrease the level of debt.
Okay. Are there any specific trends that you want to point to and how things have changed or structures have changed?
Well, if you want to put, to answer the question, factoring in a transaction, you need to be able to structure the facility in order that it give an advantage to the company, and that the financing provided by the factoring will not be considered as debt, but it's all the beauty of the product in an acquisition finance transaction.
Okay, great, thank you. We haven't really touched that much on valuation. Where do you see valuations going? I mean, they obviously are very high right now. Will that change over time?
What do you think?
Should I start?
Okay.
I don't. Or you can please go ahead if you.
No, go.
No, go.
No, I think. Well, I think. Yes, like you say, they're very high at the moment. I think that's the. That's true. And what we see also changing is that we see very high valuations also on quite small companies where it's been more conservative in the history. But at the same time, I see that same divide in valuations as we see in financing that we just discussed, that you have those assets that attract a lot of attention and they have high valuations. But we have those other assets that we think might be equally good companies but less interesting sectors where valuations have actually not increased. So we are still, I don't know if you can put an average multiple on anything, but say still discussing deals on 6-7 times EBITDA on good companies where you see others going closer to 20. So I think there's that same split. Over time, I don't think they can stay in the high end of the range where they are right now over time, and at least we are backing out on some processes because there's just no way to really kind of build a value creation case or an investment case with the required returns on those valuation levels where some assets go, at least not how we look at them, but obviously others see it differently since they are changing hands on those valuations.
Any other thoughts?
Not really.
Well,
Yeah.
maybe you can add on valuation, but it's more a personal view. You know, you've got the driver of a price or multiple, and at the moment, I think you've got a driver that will bring the price to a higher level, and other, especially the uncertainty and this sort of thing, that will push the price to a lower level. So as Pierre say, it will completely different. I mean, the valuation will be completely sectors related, quality of the asset, even structured. You know, if you put a high level of equity, the deal is less dependent on the EBITDA in order to be able to generate the leverage. So maybe if you put a large equity check, the price will be a little bit lower. I mean, there's a lot of contradiction driver on the market, and it's difficult to give you a simple answer. Or the price are going to increase, or the price are going to decrease.
It gets back to it actually gets back to
if you have that crystal ball, it would be fantastic if you would share it.
Yes.
If prices are going to go up or down.
Of course.
Yeah, I think it gets back to one of the first question. I think it's very sector driven today, and you have sectors where valuation are really going high, and other sectors where you nearly have no valuation because there's no market.
Yeah.
Do you see a link also to the IPO market? Because I think in some discussions we see with owners and founders, the IPO or kind of stock market is going up, but a lot of that is, if you simplify a lot, I mean, it's driven by a lot of technology companies, and it's not necessarily directly the economic reality where you have a lot of sectors that are mostly private companies like hospitality or restaurants or service sectors. So stock market versus how companies, small companies are performing, there's a disconnect, but I think at least to some extent the stock market and the IPO possibility also for small companies is creating a benchmark on where you would like the valuation to be. But I don't know, do you see that same driving a bit of the value expectation at least?
I agree.
No.
I agree. That's difficult.
Yeah, it sounds like it. I mean, it is the case with some of these companies. We only have about 7 minutes left, so if anyone from the audience has any more questions, please do send them in, and we can ask our panelists. Until we get another question, are there any interesting things that you can point out in terms of differences between the lower mid-market versus the sort of mid-market?
Well, I think there's a difference between the market. You know, when you're on the biggest transaction, you're very comfortable and you've got visibility again. So the way how the market will react is quite normal and is more or less the same that previously. On small cap, you know, you're much more. It will be much more sensible, and the visibility you will have is lower. So it's much more difficult to give you any prediction and in terms of price, in terms of structure, and so on. I think it will be always a deal-by-deal analysis, and it can be very different from one deal to another. I mean, if you are in the biopharma tech and you want to finance this activity because you've got an opportunity, well, you will have a lot of attraction, and many people will have a look at it, and including lenders and sponsors. If you are in a carve-out of subcontractors in the aircraft industry, even if it's a large deal, I think it will be very difficult to have something really attractive.
I think that also, I mean, if you want to be a little bit general there, I mean, of course, it's always a deal-by-deal case, but if you want to be general, I would say that lower market is less subject to changes than the upper mid-market, and has always been more conservative at many points. Although, I mean, we've seen things coming from the upper market going down to the lower market in situations where probably borrowers and sponsors were more at ease than today. But globally speaking and generally speaking, it is a market that evolves rather slowly, more slowly than the mid-market.
I guess I agree, because we operate in the lower mid-market, and I would agree with that. There hasn't changed that much. So it's also, like we discussed before, leverage ratios were lower before, they were conservative already then, they stay so. What we do see is some larger funds doing more deals also in the smaller segment, so kind of covering a broader range, but that hasn't really changed the dynamic, I would say, overall still.
Apologies, I lost connection there a bit, so I missed the answer. Does anyone else have anything to add? No, we're done with that question. No. Apologies. Okay, still don't have anything else from the audience. So I guess, I mean, we have just a few more minutes to wrap up. Is there anything that you want to say in closing in terms of any new markets you're looking at, anything that you think will impact the market going forward? I mean, we've covered things pretty comprehensively, but basically anything else you'd like to add for closing remarks? Yeah. Olivier, you want to start?
No, go.
Sorry.
I can start. Now, I think an interesting thing that we can see today on the market is basically the interconnection between SPACs and private equity. I mean, you know what SPAC is a special purpose acquisition company. You list this company on the stock exchange, and this company goes and buy private companies or public companies, but most of the time it's private companies, and actually you have a kind of reverse merger where the private company becomes a listed company, and this is quite interesting, and we're seeing that more often on the European market. It's been going on for a couple of years on the US market, but we're seeing it being more active on the European market, especially in France. There's been a record in 2020 of $82 billion, I think, raised capital for SPACs. And this is quite interesting for private equity houses, because basically I would say the level of the outlay is lower than what you would have in a normal buyout, because the investment is 2 or 3%, and as soon as you go public and you de-SPAC afterwards, you do your acquisition, you get a promote of approximately 20%, which is quite interesting. I think that it's also for private equity houses, it's also interesting that they, I mean, you have people who are used to raising capital on the market, so it's an easy job for them to do it. But now they're going on a wider range of public actors, and it's less time consuming for them than what it used than raising funds for their own funds, going to see LPs. And finally, I would say that the interesting thing is also it gives an opportunity to sell their portfolio company, because SPACs are going to be a good opportunity, and they're growing on the market, good opportunity for private equity houses to basically have an acquirer of their portfolio company. So I think that, I mean, we recently, there's been one SPAC that's been launched in Amsterdam, on the Amsterdam stock exchange market, and it's one of the sponsor was basically a private equity, well-known private equity French European player, Tikeo. So
how do you? Sorry.
Yeah, sorry. No,
Go ahead.
So I think
this
is a new market, I think, that's coming into Europe. It's been I mean, we've seen it in the US. My firm is very specialized in the US in that type of products. So we've seen it a lot, and we're seeing it now coming to Europe more often.
But can I ask you that, how do you see that evolving a kind of relationship to private equity? Is it, like you say, is it an alternative to the fund structure? Is it an exit option, or is it a competition to PE, or is it all of those?
I think it's all of those. It's a mix of all this. I think it's a good opportunity also for private equity firms to get an easier return on their investment.
Great, well, thank you. I think we're out of time actually, so thanks for the final thoughts on something to look forward to at that trend, and thank you all for your time.
Thank you.
Thank you.
Thank you.
Thank you.